Christyan, thank you very much for this interview. We saw oil prices over the past few days start to go up. On one side, economies are opening up gradually in Europe and also in the United States. And on the supply side, we saw the OPEC Plus cuts get into effect on the 1st of May. How do you see market fundamentals right now?
Nadine, I think the worst is behind us in terms of demand. Month-on-month demand growth has been up to 25 million barrels down from a year ago. As we go into May and we go into June, that number should fall to the high teens. We're expecting somewhere between 18 and 19 million barrels of demand loss month on month. The point is it's getting better. So that bottom in demand or negative demand growth is now behind us. That's really important in framing the oil price trajectory, because while you still have headwinds on storage, you still have headwinds in terms of oversupply, knowing that we have demand bottoming should help create a floor for oil prices.
What are your expectations, therefore, for oil prices going forward? Do you have projections for the current year and probably next year as well?
Yeah, as JP Morgan, we have a very non-consensus view on long-term oil. We're very bullish. We see oil going to $100 within two years. And the near term, clearly, it's very tough. And so we have an oil price that should sit somewhere between $35 and $40 by the end of the year. So while we have seen a bit of a rally in Brent, we expect that rally to be still very volatile. I'd expect as we go into the second half of this year, as we see demand bottom and we see the OPEC cuts come into play and potentially deeper cuts. We expect Saudi to announce even deeper cuts over the next few months. That taken together should see oil higher than where it is today, closer to $40 by the end of the year. But on a 2-3 year view, we see a huge supply response, a lot of oil coming off the market, and we are very bullish on the long-term view on oil.
Can you explain, when you say you expect deeper cuts, by how much? Why is that? Can you give us your views on those deepening cuts?
Absolutely. I think the framework for Saudi in terms of cutting is as follows. First point is that they're looking for more concessions from Trump. So while this oil price is painful for the US oil shale consumers, it's painful for the majors, I think the Saudis are using this oil price as leverage to get more politically through negotiations with the US. The second point is in all majors capex and volumes. We're seeing a huge reduction in capex, and that should see deferrals of volumes over the medium term. Why is that important? Because it gives the Saudis more market share over the medium term as they end up taking that oil volume through their own growth. The third is shale companies. We expect shale companies to continue to suffer. We're seeing bankruptcies. We're seeing a reset of shale volumes from around 11 million barrels to down to 9 with moderated growth. So even if oil prices do go back up, we would expect shale volumes to not grow like they used to. And then you have Saudi's fiscal break-even, which is somewhere at $80. And that's a tough place to be, which therefore means that they can't sustain these low oil prices, even if they're trying to put pressure on high-cost producers. That self-inflicted pain isn't long-term. Finally, demand. If we start to see a line of sight on demand growth over the next few months, if you put those factors together, Nadine, what we're arguing is that Saudi will ultimately say enough is enough and put together a much stronger deal into summer, which we expect could be as low as 6 million barrels from where they are today at 8.5 million barrels. So 2.5 million barrel cut is what we'd expect, but not before those factors come into play.
Let us discuss the U.S. production of oil. We saw that the idea of voluntary cuts was shelved. Having said that, as you mentioned, there are expectations already the U.S. production is down. By how much do you think? How much do you expect U.S. oil production to go down?
For this year, our estimates are that shale oil production will be down around 2.25 million barrels entry to exit. So versus a year ago, that's quite a significant cut. Moving into next year, we'd also expect a cut of somewhere closer to 1 million barrels. So if you think about the next 2 years, Jan 1, 2020, December 31st, 2021, we're expecting around 3 million barrels to be lost by shale oil production. The second part to this is not necessarily where oil shale production drops down to, but how does it recover? So what's reversible as opposed to be structurally damaged? And we'd expect that recovery to be somewhere along the lines of 500,000 barrels of growth from 2022. So it's not going to be all bad, but we think the growth outlook will be moderated. And the most important point, it will be massively rebased lower from here.
Let's go back to what's been happening over the past few weeks. Hedge funds have been net buyers of oil contracts over the past few weeks. What does that indicate? Do you think that the worst is behind us?
I do think the worst is behind us. They're probably listening to us because we have been we're the only bullish bank on oil through this crisis. The key point is that most of my conversations with hedge funds, whether it's macro funds, commodity funds, or institutional investors, seems to be around the same theme. What happens to the supply response as a result of these oil prices? And the general conclusion is these oil prices are not sustainable. You see a supply response. If oil production at the beginning of the year globally was 100 million, it's potentially falling down to low 80s by the end of this year. So 100 is, or 80 is the new 100 million barrels from a global oil production. So even as demand remains uncertain, the main focus for hedge funds now is the second, so the marginal supply, the negative supply coming through over the next 2 or 3 years. And that's important because that's around the medium part of the forward curve. The front end of the forward curve is a car crash. It's very volatile. We've seen WTI move to negative territory. But the medium part of the curve, i.e. 2022, 2023, is where the main focus is. And that's really the basis of why hedge funds are buying into futures contracts, because they can see a big supply response driving oil prices much higher.
What other things are you watching out for, Christyan, that you think would affect or impact the trajectory of oil prices in the short to medium term?
Two things. First of all, how the US shale industry evolves. If we see bankruptcies, you may think that's a good thing in terms of supply response, but actually what happens is the debt gets converted to equity, and then everyone is encouraging these companies to grow volume. So it actually has the opposite effect. So we're looking for a measured response, but we don't want to see complete carnage, because that could end up propagating more volumes from shale oil unusually. So it's very important to see how the shale industry responds. We want to see them, more importantly, mature, high grade, focus on free cash flow as opposed to just volume. So if we see a shift from shale to value over volume, that's a good outcome for everybody. The second most important point, which is stating the obvious, is demand. We need to see this floor in demand really become a floor. So if that's in the rearview mirror, the next most important thing is how that trajectory evolves. There are lots of consensus views out there around behavioral shifts in demand, that demand growth will be much more difficult over the next few years. That will be the critical path to oil prices. And so how we see the effect of this exit from lockdown on people's behavior, how we see aviation, economic growth, these are really important macro indicators to dictate the speed of the oil price recovery.
Christyan, finally, can you explain to us your bullishness on the long term on oil prices? You mentioned the $100 mark. Why is that? Can you explain when do you expect that to happen and the reasons for it?
Sure. I was saying 100 because I want to be measured. I actually think oil prices could reach historic highs, just like we've seen historic lows, potentially even at $130, $140. And the reason is fairly simple. We've run out of greenfield projects in non-OPEC, non-US. When 14 and 15, we've been bearish from 2013 all the way to now. So we've had a very consistent bearish view on oil, even before the collapse. We turned bullish because over the last 6 years, there's just been too much oil hitting the market, whether it's shale, which without a care for cash flow, with all the credit you could wish for, or the majors, non-OPEC, non-US production, which was coming out of a massive inventory build over the last decade and putting a lot of oil into the market over the last few years. What's changed? Two things. There's no more big projects to be sanctioned, so we don't have that supply outlook. More importantly, we have about $1 trillion of investment that's needed to sustain production growth beyond 2022. Now, with everything going on with the COVID crisis, it's getting worse. We're seeing more underinvestment. And the second point around the supply thesis is decline rates. At some point, you run out of oil in your reservoirs, decline rates go up, and you can't fill it with new production. So if you see a confluence of underinvestment driving plateau in supply, as well as higher decline rates, then what you have is a supply peak, which could be some point next year. So as demand recovers, and we see not sufficient supply to keep up with demand, that will create a big spike in oil prices, and not before we see inventories come down. So we need to see inventories come down. But as I said, hedge funds, investors will focus on that supply outlook and start to buy into that well in advance of inventories coming down.
Christyan Malek, thank you very much for this interview.